Hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have all of you with me tonight. I sincerely appreciate all of your efforts that you're making in the course so far. We made it all the way to week 5, which means we're in chapter 21 already. Amazing how quick the time goes by, right? What does this mean? After this chapter, next week, we'll spend a little bit of time reviewing for the midterm exam. And then the following week, take the midterm exam. Yeah, I know, right? It's here already. We're close. So let's talk about cost, volume, profit analysis, which includes things like break even. We're going to talk about cost behaviors, how to change cost, what to do when we have changes in sales price, etc. And that's what cost, volume, profit analysis is all about. So let's talk about it. It's important to understand break even. Break even is the point where our sales equal our expenses. Break even means I didn't make a profit, but I also didn't lose anything. I broke even. Okay. We need to understand how to cover our costs. And what happens when there's a change in sales price? Or what happens when there's a change in a cost? What do we need to do? Do we need to sell more, sell less, change the sale price, etc.? That's what break-even's cost, volume, profit analysis is all about. So let's talk about cost behaviors. We need to know how many units do we need to sell to break even? Do I need to sell 10, 20, 100, couple hundred? How many units do I got to sell to cover my cost, to break even? What if I have an increase in income and I want to install a new piece of machinery? Will it reduce my labor costs? I don't know. It's a behavior cost question. What will be the change in income if my sales price goes down and my volume increases? Or what if I put something on sale? Right? I reduce the sales price. Well, that's good for the customer, but does that mean I need to sell more to break even? It's a cost behavior question. Or how will my income change if we change this sales mix of our products and services? What if I sell a variety of products or services? And what happens to sales volume that we need to earn a target profit or target income? These are the kinds of things we're going to talk about. First, and we've talked about this a little bit before, understanding our costs are so important to our business because I need to be able to cover those costs. Yeah, I need to be able to make a profit. And so we need to look at our fixed costs, our variable costs, and what we call mixed costs. Fixed costs represent costs that do not change regardless of the level of output. This would include things like rent, supervisors' salaries, depreciation, etc. They're costs that do not change. regardless of the level of output. We call those fixed costs. Fixed costs and variable costs need to be covered in terms of sales volumes. Variable costs, as you know, represent the total cost of a unit. It includes things like direct labor, direct materials, and a little bit of factory overhead. Those are my variable costs. Variable costs change with the level of production. Fixed plus variable costs need to be covered in order to generate a profit or to break even. We call these total costs. Fixed plus variable cost equal total costs. On the top part of this slide, we can see the relationship between the number of units produced and our total cost. Our total costs rise with the more units I produce. This is represented by the green line there. On the bottom part of our slide, we can see the relationship between a cost per unit and the number of units produced. On a per unit basis, we see that the total cost per unit decrease with the more units I produce. Okay? It's important to understand that relationship for fixed costs. So also looking at the top, on the top part of the slide, we see our fixed costs do not change regardless of the level of output. If we take that fixed cost and we divide that by the number of units produced, we could get a fixed cost per unit. Yeah, and we see that relationship there at the bottom. We do the same thing with variable costs. Looking at variable costs per unit and total variable costs. Total variable costs, of course, rise with the level of output, as shown by the light orange type color at the top. And then we also see that if we look at it on a per unit basis, variable costs remain the same. Remember, variable costs represent direct labor, direct material, factory overhead, the cost of manufacturing a single unit. If looking at the top part of the slide, we see that our variable costs rise with the more units we produce. It's $20 per unit. If we look at it at a per unit basis, like on the bottom part of this slide, we see that it stays the same. We also have what's called mixed costs. Mixed costs are a combination of fixed and variable costs. An example of a mixed cost would be leasing a copier machine. When you lease a piece of machinery, oftentimes that contract for that lease will tell you that it's based on usage. For example, a copier machine might say the cost per month is $1,000 up to 10,000 pages. Okay, 10,000 pages, $1,000 a month. So think about this for a second. If the cost is $1,000 a month, that's up to 10,000 pages per month. That gives you a per sheet cost of 10 cents. Okay? Now, the contract will also say, once you've reached that 10,000 page, every page thereafter is an additional 10 cents. Okay? The fixed cost part is the $1,000 a month. The variable cost part is the 10 cents per page thereafter. So it'll be 1,000 plus however many pages times 10 cents. That would be a example of a mixed cost. Does it make sense? You all understand that concept? Mixed cost? We good? Make sense?
Yes.
Awesome.
It does.
Great. Thank you. Some cost structures might also include what we call a stepwise cost system. It sounds kind of silly, right? Here's the example I'm going to use to explain this. Think of your cell phone plans, okay? Your cell phone carrier will say, your monthly bill is $40 per month with 1 gigabyte of data per month. Okay? Sounds reasonable. That's a good deal. The cell phone company will say, if you go over that 1 gigabyte of data, we will provide you with 3 gigabytes per data, but the cost will be $60 per month. Okay, until you've reached that capacity. They're using what's called a stepwise cost plan. It's based on tiers, based on usage, right? So that's what a stepwise cost system is. The costs increase based off of a range, a tier of activity. Yep. And some cost systems might use what they call curvilinear costs. Basically, it's nonlinear, right? Curvilinear. Costs increase when activity increases, but in a nonlinear fashion. Curvilinear. Yeah, kind of, we call this cost smoothing. Yeah. In business, it's important that we are able to estimate our costs. And to do that, we might use a scatter diagram, a high-low system, linear regression, or other methods of estimating costs. I know it sounds complex. Don't worry, I'm not going to go all statistics on you, but I just want to show you some easy statistics to help you to understand how we estimate costs. We first look to classify whether costs are fixed or variable. And we do that by looking at these 3 different methods: scatter diagram, the high-low method, or linear regression. Here's an example of a scatter diagram. We see that the estimated cost line is in between or as close to as our cost points. Our cost points represent the cost at specific units. For example, the little dots represent months, and the months represent different units at different cost points. The scatter diagram helps to estimate the cost behavior by putting a line through your data points to graphically represent the closeness in cost. Yeah. Of course, there's going to be a couple of outliers that they might be a little further out, but for the most part, we see that the line is very closely correlated with our data points. Call it a scatter diagram. The second method is called the high-low method. This is very easy to understand, but I'm going to walk you through it. The first thing we do is we identify the high points and the low points by looking at the data. So here we go. First, let's identify the high points, the highest cost. Looking at this 12 months of data, you can tell me what month is the highest cost, the highest total cost. What month is the highest total cost? What do you think? What month is the highest total cost in? And I know you know the answer. It's right in front of you. Highest total cost? Tell me.
It looks like May.
Nope.
Oh, wait. I'm sorry. I'm trying to look. Give me 1 second.
That's okay. Highest total cost. It's on the right side.
Oh, I see it. November.
November. Yeah, I know. So it's the way the data is organized. Yeah, I know. Yeah, November. You're right. So November is my high month, 67,500 units. Total cost 31,000. What about my low? Where's my low at? Lowest point. Lowest total cost. And I'm looking and I see, looks like June. Yep, looks like June. Lowest cost, 18,500. With the units of 17,500. So my low is June. My high is November. So we found the high and the low. We need to compute variable cost per unit and total fixed cost. Here's how we do it. The high, November, 67,500 units, total cost 31,000. Low, June, 17,500, cost of 18,500. We need to find the difference between the high point and the low point. To do this, we very simply subtract the high from the low. So the difference is 50,000 units, and the difference in cost is 12,500. If I divide the difference in cost divided by the difference in units, I get a per unit cost of 25 cents. 25 cents per unit. Okay. So I could take my total cost, 25 cents per unit is my variable cost, yes? To find the total cost, I take to find the fixed cost, I take my total cost to equal fixed, which is X, plus variable cost times number of units. I take variable cost times number of units to get my total variable cost. If I take my total cost minus my total variable cost, I can find my fixed cost. In this example, 14,125. It's kind of like working backward, yes? Solve for x. So that's high-low. And then regression analysis, or linear regression, is covered in advanced accounting courses. But just so you know, we usually use something like a spreadsheet or a graphing calculator. And of course, the objective is to determine the total fixed cost and the variable cost per unit. Don't worry, I'm not going to have you do that. But I'm just going to quickly tell you about it, that's all. And we can see that with the estimate, there's a difference between the high-low method and the regression method. And that difference, it depends. So a company might select one method over another to get an estimate of our costs. Okay? So now that we understand how to estimate our costs, we need to figure out our contribution margin so we can figure out what our company's cost structure looks like. The contribution margin represents, in theory, the amount of profit per unit. That's what contribution margin means. The word margin means profit, basically, per unit. So a contribution margin per unit is kind of like saying the profit we would expect if we sold one unit. So to find the contribution margin per unit, we take the sales price minus total variable cost per unit. Let's say we sell a calculator at a cost of a sales price of $100 per unit. Our variable cost, the cost to manufacture that calculator, is $70 per unit. So sales price 100 minus variable cost 70 gives me a contribution margin per unit of $30. $30 potential profit per unit. I also want to find what we call the contribution margin ratio. Again, this kind of shows us the percentage of profit that I would earn from each unit. So we can take the contribution margin per unit that we found from step 1 and divide that by the sales price per unit. So $30 divided by $100 gives me 30%. Now that we know our contribution margins, we can find break even. Break-even point is where our total sales equal our total expenses. The company has neither earned a profit and has not incurred a loss. We broke even. This can be expressed in either sales dollars or number of units we need to sell. There are 3 methods to find break-even. One is by using the break-even formula. The other is by taking contribution margin income statement. And the third is a cost volume profit chart. First, let's look at the break-even formula. The formula is very straightforward. It's fixed costs divided by contribution margin per unit. This is to find break-even in units. So fixed costs in our example is $24,000. Our contribution margin per unit is $30. This means I need to sell $800 per month. 800 units per month to break even. What is that in sales dollars? To find it in sales dollars, we take fixed costs divided by the contribution margin ratio. Fixed costs of $24,000 divided by a contribution margin ratio of 30%. So $24,000 divided by 0.3, which is 30%, equals $80,000 of monthly sales dollars I need to sell every month in order to break even. The second method to find break even is what we call the contribution margin income statement method. On an income statement, as you know, we have sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals income. Right? To find the contribution margin using this format, we take sales minus variable costs equals contribution margin minus fixed costs equals income. And the last method is by using a chart. This is what the chart looks like. The point of break even is where we've neither made a profit nor a loss. We didn't lose money. We didn't make money. We broke even. Point of break even graphically is where the sales and expenses intersect. Sales and costs intersect. Oftentimes it's necessary to revise our estimates. I like to think I can sell a lot of units or sales dollars. I'm optimistic. Or I think I can do pretty well. I might be most likely. Or, I don't know if I could do that. I'm pessimistic. Okay. In order to have estimates, we need to have some ranges. Think high, medium, low. Yeah. And we can do that with sales price, variable cost per unit, and fixed cost. High, medium, low. And we need to find the break-even point for all three levels. And so to do that, we will take our fixed cost divided by our contribution margin per unit to find the number of units we need to sell in order to break even. So if we're looking at a most likely scenario, we would take total fixed cost divided by $35 contribution margin to equal 686 units. The $35 contribution margin came from the change. So there's a couple of different ways of looking at the point of break even. One of those is called the margin of safety. The margin of safety, the word simply means that I can safely sell this number of units or this amount of sales in order to generate a small margin. So we call it margin of safety. Here it is in percentage. Sales minus break-even sales amount divided by expected sales gives us the margin of safety in percentage. So if we expect to sell $100,000, our break-even is $80,000. Divided by $100,000, that is 20%. 20,000 over 100 is 20%. I can do that in terms of units as well. Computing your net income from sales and costs, it's just a matter of reversing your income statement. So to find net income, we take sales minus variable costs equals contribution margin minus fixed costs will equal your net income. We reverse that to find our sales amount. Take net income, add in fixed costs to find your contribution margin, then add in your variable cost to find your sales. Yeah, it's kind of like working backward. But it shows you how we can do that in order to compute sales from your costs. Oftentimes businesses, especially new businesses, they have a particular profit in mind. Oh, I want to have an income of $12,000 or $100,000 or whatever. I want to make this amount. How much do I need to sell to make that amount? We call that a target income. And we build it into the formula in order to help you to generate that amount. So we take fixed costs plus your target income divided by the contribution margin ratio to find how much you would need to sell in terms of sales dollars to get your your target income. Your net income to be that 12,000. Yeah. And we do that. We can do that same thing for the number of units that we need to sell. Fixed cost plus your target income divided by your contribution margin per unit tells you how many units you need to sell to generate an income of $12,000. You can also work backward to find the sales amount using that same process. Because once you have contribution margin, you just add in variable cost to find your total sales. Sometimes, based off of your estimates, your strategy might change, which means you have to revise your break-even point. And we do that by taking revised fixed costs divided by your new contribution margin ratio to find your revised break-even point in terms of dollars. You do the same thing in terms for percentage as well. In most cases, companies don't sell just one type of product. They sell a lot of different products. We call that a sales mix. You probably remember that term from your Intro to Business course. Sales mix. The sales mix represents all the different types of products that the company sells. Okay? In order to find the cost, volume, profit, or the contribution margin, we take what's called a composite unit. Think of a composite unit as being the contribution margin for the sales mix. Composite unit. It's the contribution margin for all of your different products that you sell. Instead of doing it for each individual product, you do it for the whole company using the composite unit. Sales mix is the ratio of the volumes of various products that the company sells. Based on the break-even formula, the composite unit sales looks like this. Fixed costs divided by your contribution margin per composite unit. So in other words, we're swapping that contribution margin for the composite unit. Yep. Here we have an example. We have a company here that provides haircuts as a service. There's 3 different kinds of haircuts that this company provides. Basic, the Ultra, and the Budget. Ultra is the top tier, Budget's the low end, and the Basic's middle of the road. So we have some data. Annual fixed costs are $192,000. We need to compute the break-even point for composite units using the sales mix below. So, looking at the sales price and the sales mix ratio, we can also find the sales price per unit and this total selling price per composite unit. The contribution margin per composite unit is $64. How we got that? We took the sales price per composite unit minus the variable cost per composite unit. For a company that sells multiple products, to find break even, we simply substitute the margin per unit for composite units. So fixed cost divided by contribution margin per composite unit, fixed costs, and then we plug in the data. So $192,000 divided by $64 per composite unit tells us that we need to sell 3,000 different haircuts in this example. We take the composite number of cuts times the 3 different sales mix levels to tell you how many haircuts exactly of each product you need to sell to break even. Once we've done that, we can find the income statement data broken out based on the individual products that we sell. If our net income is 0, that means we've reached the point of break even. That's where our total contribution margin equals our fixed costs. With cost volume profit analysis, there's a couple of assumptions that we need to take into consideration. One is that costs can be classified as either being fixed or variable. Costs are linear within a relevant range, and all units produced are sold, and that the sales mix is constant. Those are the assumptions, okay? These are the things that we say, these things are true when we're calculating cost, volume, profit analysis. Of course, with all assumptions, there's some limitations as well. There's a couple of ratios, as you know, as there always is, right? With every course that we have, that you should know about. One of these is called the degree of operating leverage. This is more of a finance term than it is accounting. But the degree of operating leverage shows us the percentage change in sales and what the effect will be on our profits. Yeah, so this is kind of important, right? So to find the degree of leverage, we take the total contribution margin in terms of sales dollars. We divide that by our net income. Yep. And the degree of leverage in this case is 3 in this example. 36,000 divided by 12. Sales minus variable costs equal contribution margin minus fixed costs equal the net income. Call it pre-tax income. What does this information tell us? If the company increases sales by 10%, what will the percentage increase in income be? We take to find the change in income, we take the degree of leverage times the percent change to find the change in income. In this example, 30%. So I'm not going to have you do this, but I just wanted to show you what the regression analysis looks like we talked about earlier. You can use what's called the least squares regression analysis in order to find this type of information. Don't worry, I'm not going to have you do that. I just want to let you know that this is something that some accountants will do using big data to analyze that information to ultimately find assumptions and changes looking at this type of information. Don't worry, I will never have you do that. Now, and also talking about cost, volume, profit analysis, it's also important to understand how to compute the unit cost based on absorption and variable costing. You'll learn more about this in your cost accounting class if you go on to cost accounting. But the idea behind it is that within absorption costing, the word absorption simply means that we take all the costs into consideration. So fixed and variable costs are absorbed. Okay? Whereas variable costing, we're only looking at variable costs. We're separating them out. Yep, so variable costing, we're only looking at the variable costs. Under absorption costing, we're taking into consideration fixed and variable costs. But primarily looking at direct materials, direct labor, and all of factory overhead, so fixed and variable costs. Are there any comments, questions, or concerns about cost, volume, profit analysis, how we find break even, anything like that? Any questions at all? It's relatively straightforward. What do y'all think? Did we do okay? Maria?
Everything's good, Professor. No questions.
Great. Awesome. Wonderful. Thank you, Jamil. Appreciate that. Okay. So for this chapter, here's what we got going on. In the classroom, thank you, Maria. In the classroom, we made it all the way to Module 2. Okay. Wow, holy smokes, we made it to Module 2. Week 5, Chapter 21. My recommendation is maybe tomorrow or on Thursday, do the exercises, review the PowerPoint presentation, and then attempt the homework. Okay, homework very similar to your previous homeworks. 5 questions, mixed true, false, multiple choice. Obviously there's some math involved. So work through the homework assignment. Try it. Give your first attempt on Thursday during the class time. That's why I allow this extra class time, right? Is to provide you that additional time to do these types of homework assignments and to try things out. And hopefully you're taking advantage of that time because that's what it's there for. Yep. Instead of, you don't want to be sitting there Sunday scrambling. You got a lot of other stuff to do. So use the class time on Thursday. Give that homework a shot. And then see how you do. And then if you need to, try it again. But make sure you submit it by Sunday night at the absolute latest, preferably on Thursday during class. Now, I also want to point this out. You'll notice next week there's nothing there. So the following week, midterm exam. What does that mean for you? So next week we'll have a session, and we're going to review for the midterm exam. The midterm exam is going to cover chapters 17 through 21. It's going to be mix of true, false, multiple choice. I'm sure there'll be some math questions in there. And I believe it's about 5 questions per chapter, thereabouts. So I would expect probably 20 questions or so on the midterm. So next week we'll review for it. I'll allow you to ask questions. We'll look at the questions. We'll talk about it. Talk about where to find the information to answer those questions. And I promise I'll make it nice and easy. So make sure that you're here next week on Tuesday, and we'll do a review for the midterm. And hopefully they'll help you. Any other comments, questions, concerns? Anything at all? Okay, great, wonderful. So having said that, thank you all so much for your time. I really appreciate it. I appreciate you being here. I also appreciate the fact that you're all doing really well and that you're trying your best to make sure that your work's done on time. If for whatever reason you're late, just please make sure that if you missed something, make sure you get that in. Really, really important. That's definitely before the midterm, right? Because that'll help you. Because it's like practice, yeah? So with that, if you need anything, I'm here for you all the time. You can always email me, call me, set up office hours. I'm here for you. Yeah, here to help you. And with that, remember to stay safe. Wash your hands. Yeah, definitely do that. Stay safe. Wash your hands. Do the right things, and I'll see you all again next time. Thank you so much. Enjoy the rest of your night. Appreciate all of you. Thank you. Bye bye.